Hello, I'm John Kreitler, Kreitler Financial. Welcome to the second half of week 4 of our investment course, How to Be a Better Investor and Understanding Finance. In the 1999 speech of Warren Buffett to Allen Company, the investment symposium, he spoke about regression to the mean. Regression to the mean is a concept as it relates to investment that's very, very important. Anytime you hear in the popular financial media or in books or a newspaper, whatever it might be, that this time is different, your antenna should go up. Warren Buffett talked in this speech first about the level of interest rates, but then he talked about two other factors, both encompass the idea of regression to the mean. You take a historical sample, you see where the baseline is. If you're below or above that baseline, typically over time, you're going to get back to that baseline, either rise to it or go down to it. He talked about specifically corporate profits, profit margin in relation to gross national product, GDP. Typically, it's about 6%. It was approaching 8% in 1999. So therefore, for the good times to continue on into the new millennium, you need a corporate profits to stay at that level and even to go higher. Even though regression to the mean would state it would actually come down. So be careful what you are bidding these stocks up for in terms of their price. Another thing in terms of regression to the mean is investor appetite, investor expectations. Typically 6 to 8% per annum is what a person should be expecting from the stock market over time. When people start thinking they're going to make 10, 12, 14, 20% per annum, as they did in 1999, because this time was different, his antenna went up. He pulled back, Warren Buffett and Berkshire Hathaway, raised cash, waiting for the inevitable dip. And the dip it was in between 2000 and 2003. There was a vicious bear market and the bust of the dot-com bubble. Those luminaries at the Allen Company conference were not expecting that over the next couple of years. They thought things were going to continue in 1999 going into 2000, 2001, and it did not. It's important for us to understand now the idea of regression to the mean as it relates to macroeconomic statistics and trends, as well as our fellow investors' appetites. When they start getting frothy and speculative in certain things, as they did COVID and post-COVID, it's important for us to understand typically to be disciplined, to wait for the proper entry point as it relates to a long-term investment, because to be a good investor means to be willing to have a holding period, 3, 5, 10 years, and watch over your investments. For week 5, we're going to be talking about the great financial crisis, 2008, 2009. I'd like you to listen to the Wall Street Journal interview with Warren Buffett. I'm John Kreitler. Thank you again for watching. Have a great week.